Good afternoon, everyone. My name is Peter Leppones, and welcome to Apella Academy. Today, we're going to discuss 5 strategies that you need to know about your IRA. Some of them seem fairly simple and straightforward, but we want to show you what can happen if things are done incorrectly. Others, more technical in nature, so we'll go through those in some detail and try to explain them in easy to understand terms. One quick thing I did want to mention, our original email going out said that this was a 60-minute presentation. In reality, it's only 30 minutes, so things will be moving along a little bit quicker for you this afternoon. Apella Academy is a bi-monthly webinar covering a variety of different topics. We host these webinars for our clients and their family and friends in order to help educate everyone. We feel that having a well-educated client base is extremely important. An informed and educated client will make better financial decisions and will be more likely to stick to their plan during difficult times in the market. Today, we're recording this presentation, and in a few days, we'll have it put up on our website, apellacapital.com. Go to the Videos tab, and at the top, you'll see this presentation, along with past presentations on topics such as long-term care and Social Security. If you do find any of these topics interesting and you feel worth sharing with any friends or family members, please feel free to do so. Also, we encourage you, if you have any topics that you find of interest that you think would be beneficial for us to have as future sessions of Apella Academy, please let us know. So here's our agenda. Again, we want to go over some basic, very common mistakes that people can make with their IRAs. And they're not always just made by the investors. They can also be made by advisors as well. And we want to talk about some strategies that can help not only save you money in taxes, but can also help avoid lengthy delays in probate, and also a way to have your IRA passed along to future generations. So our first topic that we'll discuss is beneficiary considerations. We'll also talk about stretch IRAs, required minimum distributions, qualified longevity annuity contracts, commonly known as QLACs, and we'll end with Roth Conversions. A bit about me. I'm with Apella Capital. I've been in the investment and insurance arena for my entire career, over 20 years. And prior to joining Apella, I was working in a wholesale capacity with life insurance, long-term care, and income annuities. I graduated from Central, and I live in Southington with my wife and kids. So our first topic we want to start with is beneficiary considerations. And this is pretty simple and straightforward, choosing your bennies, but we want to take a look at a couple of situations for if you do make mistakes, it can cause a great deal of inconvenience to your loved ones. So the first question for everybody is, when was the last time you checked the beneficiary designations on your IRA, or even your life insurance policy for that matter? But let's focus with the IRA. If you've had your IRA for 15 or 20 years, there may have been some significant changes that you have gone through in your life, and have you kept your designations updated with your wishes and where you are today with your life? The ability to have a named beneficiary on an IRA is a very powerful tool, and we want to make sure that you have kept that information up to date over the years. It's an easy enough thing to change the beneficiary on your IRA, just some simple paperwork. But if you don't have the correct beneficiary listed, after you die, it can cause a great deal of inconvenience and trouble to your loved ones. So there's 2 types of beneficiaries, primary and contingent. The primary is the first in line, and the contingent is the backup. For example, most people will have their spouse to be the primary beneficiary on the account, with their children being the contingents. So if my spouse and I were to get hit by a bus crossing the street, our children, being the contingents, would receive the proceeds from our accounts. Keep in mind that if your children are minors, the proceeds would not be directly made available to them. A guardian needs to be named, which is done via a will, and then the proceeds are set up in an account for that guardian to safekeep to use for the children's benefit until they become adults. But let's take an example here where the spouse being the primary beneficiary, but now let's throw a divorce into the mix. So if you have a husband with an IRA and he gets divorced from his wife, but never removed his ex-wife as the beneficiary and he were to pass away, the ex-wife would be entitled to the beneficiary 100% of the IRA. Well, obviously he does not want his ex-wife to be his IRA. What if he wanted his new wife? There's a remarriage involved. At that point, once he's passed, there isn't a whole lot that can be done. So let's continue to look at this situation, but let's say after the divorce and the remarriage, he did name his new wife as the beneficiary. And when he made that change, he said to her, I'm making you the beneficiary of my IRA, and if I die, the money's there for you, but I would also like you to use some of that money for my two kids, her stepkids. The problem with that is she's under no legal obligation to do something like that. A named beneficiary, they get the proceeds, they can do whatever they want. And again, once it's done, there's not a whole lot that can be done. So these are situations where making sure you have the correct beneficiary, perhaps utilizing a trust as well. What a trust allows one to do is to, we use the terminology, control your money from the grave. So you're setting up something today that will allow your wishes to remain going forward, even though you may no longer be here. So again, the question we'll ask, when was the last time you've checked your beneficiaries? It's a real important, yet very, very simple exercise to go through. And this is something here that we can help you with at Apella Capital. Another thing you may or may not have heard of, this terminology. It's not common, but people talk about it. So I want to talk about the definitions and use an example. I think that's the best way to illustrate it. The term PerStirpes versus Per Capita. And here's the example we'll use to explain that. Where you have a mother who has passed away with 2 adult children as her primary beneficiaries. Her children's names are Amy and Bob. Amy and Bob would be set up to get 50% of her IRA, but suppose Bob died before his mother and she never updated her beneficiaries. Let's go a step further. Say Bob had a child named Bob Jr. So the 50% that was supposed to be going to Bob, who should be getting that now? Should Amy get it, being the only living sibling, or should Bob Jr. get it, being Bob's son? If you want Bob's share to be inherited by Bob Jr., then the share passes PerStirpes. Use the terminology or sort of the memory clue of down the stripe, meaning it's going to go from father to son, sort of stay on that side of the family. If you want Amy to get the entire estate, thus shutting out Bob Jr., then the estate IRA is per capita. Per capita distribution looks at the number of surviving heads on the generational line. Typically, per capita is the default. So in this instance, where Bob Jr. had passed away before his mother, Amy would be 100% beneficiary of the IRA if there wasn't anything mentioning PerStirpes on the beneficiary form. We don't see this often, but again, felt it was worthwhile mentioning to you. If there's any questions on that, we'd be more than happy to discuss that in more detail after the presentation. These are 2 important ones, making an estate or a trust as your beneficiary. And I see this estate one quite often. Unless you've gotten specific and sound advice from your attorney, I'd recommend not making your estate the beneficiary of an IRA. After your death, the beneficiary can have access to your account value as soon as they have a certified death certificate and complete the death claim paperwork. And really, they could have the money in a matter of days or a couple of weeks. If you have estate listed as your primary beneficiary, the funds technically cannot be released by the custodian until the IRA has gone through the probate process, and the state probate court system will then determine who receives the proceeds. Now, if this were to happen to you and you have a spouse and or children, in all likelihood, if you had left it as your estate, they will probably get those proceeds. But why take a chance and why make everybody wait? Probate can take months, and there may be financial obligations that your family may need that money for in the meantime. As far as a trust goes, this can get a little tricky. So depending upon the type of trust that you have and also your goals and objectives, there could be a variety of different outcomes. Some of those outcomes could be beneficial, others may not be. Having your trust being named beneficiary of your IRA, it's a very complex estate planning technique and should only be done with the assistance of a qualified estate planning attorney. If you feel you need to speak to an attorney about the best way to protect your family, we do have several that we work with that we'd be happy to provide you with any recommendations that you may need. Next up is Stretch IRA. The Stretch IRA is a very powerful tool that, when done properly, can have your distributions that go to your children and maybe even to your grandchildren. I've seen many IRAs taken out as a lump sum by the beneficiary, and the short-term and long-term ramifications can be significant. Many of these instances, maybe someone just needed the money or it was a smaller account. But I want to take a few minutes to walk through the Stretch IRA and explain it to you in some detail. So we want to look at the different types of beneficiaries because, again, if you're married, in all likelihood, you'll have your spouse as your Benny, and a spousal beneficiary gets some special privileges. You can, at the death of a spouse, the surviving spouse can automatically take over that IRA. It becomes theirs. They can put their name on it, and it's theirs. No taxes, and it's as simple as filling out some paperwork. A non-spousal beneficiary, in this instance, let's focus on children, will not have the capability to take over an IRA in the manner that a spouse has. So one of the options, again, is the lump sum. Another option is the Stretch IRA for a non-spousal beneficiary. So let's really focus on looking at the lump sum, what can happen when you do it, and then talk a bit about the Stretch IRA. So a non-spousal beneficiary does have the option to take a lump sum, and this can be a mistake for a couple of reasons. Let's take an example. You have a 46-year-old child who is named the beneficiary of his late mother's $100,000 IRA. If he were to take that lump sum, he would have to pay tax on the full amount, which would not only significantly reduce the amount that he's going to receive, in addition to that $100,000 would be considered taxable income in the year it was received, and in all likelihood is going to increase his tax bracket on his regular income. So the income he's earning from his job, he'll be paying a higher rate on that as well. So hypothetically, maybe he, instead of the $100,000, maybe he's only going to get about $65,000, $70,000, somewhere in that neighborhood, depending upon his tax bracket. But if he were to stretch that IRA out, in essence, what he is doing is having minimum distributions come out based upon his age. So minimum distributions on a 46-year-old, and the younger you are, the less minimum distribution you have to take out. That money is also staying invested and growing tax deferred. So you have less money coming out plus growing tax deferred. If we run a conservative 4%, there's a potential of getting out over $250,000 in income over that 46-year-old's lifetime. And so again, it's a very powerful tool. So this is something that's going to continue to generate an income for him, for his family, and also from a tax standpoint, he's controlling his taxes. He's not getting hit with a huge tax burden in 1 year. And every year when he gets that check, he's going to be thinking of his mom. Geez, here's the check from mom. And will he use that for a family trip? Will he use it to pay bills? Will he use it for college expenses for the grandkids? So this is a great way for you to have a legacy that continues to go on to your children and also to your grandchildren. And keep in mind, by doing the Stretch IRA, you're required to take out a minimum amount, if an emergency ever did come up and they needed to go in to get something out due to a car repair or a home repair or a medical expense, they can always go in and take out more if they need be. They just need to understand that there'll be tax consequences for doing so. But again, a very, very powerful tool. We did talk about a little bit about the minimum distributions with the stretch IRA, but I do want to spend some more time focusing on that because it is a very important topic and one that people get a little nervous about. So they're not overly complicated, and I think the reason why people do get a little nervous about them is anytime you're dealing with the IRS forcing you to do something, it can take on a life of its own. So the IRS is saying at age 70 and a half, you need to start taking money from your IRA. So let's break down how this works. And if we approach this systematically, I think we can take away some of the anxiety that people feel regarding this topic. So RMDs, required minimum distributions, must begin at age 70 and a half. With your IRAs, if you have a SEP IRA or a simple, also we can put in there a qualified retirement plan that you may have through work, such as a 401k or 403b. If you're no longer working, the monies will have to come out of there as well. Technically, age 70 and a half, you can actually wait until April 1st of the calendar year after you turn age 70 and a half to take your first MRD. So that allows you to delay it for a year, but then what you're doing is you're actually taking two distributions in 1 year. The one from last year plus the one for the current year. The calculation itself is actually fairly simple to make. You take your account value from the end of the last year, December 31st, divide it by the IRS life expectancy factor, and you have the amount you need to take for that year. So a couple of quick examples. If we have a $100,000 balance in our IRA on December 31st and we're 70 right now, we have to take that this year. The IRS factor for us is 27.4. So 100,000 divided by 27.4 is 3649. On a 71-year-old, the factor is 26.5. That would require us, based on a $100,000 balance, to take out $3,733. A 72-year-old, we have a factor of 25.6. That gives us a distribution amount of 3906. So every year, the factor forces us to take out more and more money every year. So at a 70, we were taking out 3,600, 71, 3,700, and 72, 3,900. And that's not even factoring in any growth that we may encounter due to investment performance. So the older you get, the more you're going to be taking out of your IRA. So each account you have needs to have an IRA distribution calculated from it in that given tax year. So if you have 5 different accounts, that's 5 different calculations, 5 different withdrawals that need to be processed on time. And if you forget to take one of them, the penalties are pretty steep, 50%. So if you were supposed to take a $10,000 distribution from one of your IRAs and you forgot to take it by the end of the year, you'll have a $5,000 penalty to pay to the IRS. So the good news is that many carriers and custodians will actually be very helpful with minimum distributions. They will help you to calculate your minimum distribution. They'll have your year-end balance from the prior year, December 31st, and there's paperwork that you can complete for it to be calculated and have a check sent to you automatically every year. So another nice function that you have is if you have those several IRAs, you can calculate the total amount for all of the IRAs and take that total amount from just one of them. This strategy can work really well if you have an IRA that is locked into, say, a low interest rate, or if you're inside of a product, say like an annuity with a long surrender charge that you might not be happy with. This is a way to maybe get the money out a little bit quicker. I had a client once He had two fixed annuities. One was paying 3%, one was paying 4%. And we sat down and just do some planning. And I recommended, well, let's not take it out of the 4% when we can take it from the 3%. You're costing yourself money that way. Keep it in a better interest rate and take from the lower interest rate. So little strategies like that, little tricks like that can be a big difference for you. If you do want to do a review of your IRAs with us, we can help you to get organized. This is something to maybe start now, a couple of years really before you start taking your minimum distributions. If you do have several IRAs and you are taking minimum distributions now, it's not just about the minimum distributions. It's not just about checking your beneficiaries. Where are you invested? Are you invested properly based upon your risk tolerance? What are your fees and charges on your IRAs? We have some very cutting edge resources and tools and programs that we can use to help you retire with confidence. And I'd like to show you just one of the programs that we use with our clients. This is just a hypothetical scenario that we did using our financial planning software. We have a couple in their mid-50s that we used this required minimum distribution program to determine how much they'll need to take from their IRAs when they're 70 and a half. Even though that's only 15 years from now, we were able to get that calculated for them. So in addition to that, we were able to maximize their monthly income from their Social Security and also utilize some after-tax investments for income so that they're actually going to let their IRAs continue to grow tax deferred and will then have those as a funding source for their retirement once they reach age 70 and a half. And again, these are just some of the strategies just by taking a look and sitting down and doing some planning that can make a real big difference going forward with your retirement program. Next up, we have the Qualified Longevity Annuity Contract, or the slang term is QLAC. This is a relatively new concept. It came into being in July of 2014 when the IRS made some changes to the minimum distribution rules. What makes this unique is that if the changes by the IRS, and there was a product out there that fit quite nicely into these changes, and really these changes in the product worked hand in hand to provide some nice benefits for the clients. So a deferred income annuity is basically like setting up a private pension, and that's what a QLAC is. It will give you a specific amount of money for a specific amount of time at a specific point in the future. Again, just like a private pension. While this is a very interesting product, it's not going to be for everyone. This is going to be for the individual who doesn't necessarily need the RMD from their IRA for income purposes. They may have other sources of income, such as their own pension plan from their previous employer. Maybe they have after-tax accounts or a muni bond portfolio that they're drawing income from. So this concept allows you to transfer a portion of your IRA to a QLAC, and a QLAC is qualified money. It's, in essence, its own IRA. This would be a tax-free transfer, just like going from IRA to IRA. The benefits are you get a guarantee of not outliving your money. Since your IRA balance is now lower, your RMDs are going to be lower, and this will give you a sense of comfort because you have a guaranteed source of income in the future. It will allow you to not have to worry about, say, taking that extra trip or maybe gifting money to your children or grandchildren. Let's look at an example here. So we have a 65-year-old female with a $500,000 IRA. She has other sources of income. No need for the minimum distributions at age 70. It's just she's going to take it, going to pay tax on it, and she's just going to put it in the bank. So if we were to move $100,000 from her IRA to a QLAC contract, the benefits of doing that are it's going to reduce the value of her IRA by $100,000. So for minimum distribution purpose, the QLAC, the government is not going to count that as part of your IRA balance. So now she goes from a $500,000 IRA balance to a $400,000 for the purposes of minimum distributions. And that's going to decrease the amount of RMD by 20%. 20% less taxes she's going to be paying. So this will allow her to utilize that money if she wants to start taking money out of the IRA, again, to do something special for the kids, or to take those trips, or to make improvements to her home. She can do that knowing that at age 85, if she's still living and still healthy, she's going to have a way to tap into that money automatically. She basically will flip a switch and she'll get out $2,200 a month for the rest of her life. Whether she lives to 90, whether she lives to 95, 100, 105, it's guaranteed for her life expectancy. So the IRS limits $125,000. The max you can put into a QLAC is $125,000, or 25% of the total IRA balances, whichever is less. If she were to do this program, and die prior to age 85, her beneficiaries would receive her principal back, so the $100,000 would come back to her children. And there is an option built into it to refund unused principal to the beneficiaries if she were to pass shortly after payments were to begin. So our final topic that we have for here today is Roth Conversions. Roth IRA is another powerful tool that can provide you with tax-free source of income in retirement. Not everyone is eligible to contribute to a Roth based upon their income. Roth income limits for a married couple filing jointly are $184,000 for 216, $117,000 if you are single. You can contribute $5,500 per year if you're over age 50, you get an additional $1,000 catch-up to add on top of that. A quick review on the differences between the traditional and the Roth. Traditional allows you a tax deduction on your contributions, but you'll pay taxes on the withdrawals in retirement. The Roth does the opposite. You're putting after-tax money in, so there's no tax deduction on your contributions, but when you retire, start making your withdrawals, you won't pay any taxes on the withdrawals and the growth that has occurred inside of the IRA. So the IRS allows everyone to convert existing IRAs to a Roth without having to worry about income limitations. Here's a couple of different ways to do this. You can contribute to a traditional IRA even if you are not eligible for the deduction, and then convert the traditional IRA to a Roth. If you have a rollover IRA from a previous job, you can also convert that to a Roth as well. Another way to get a Roth type of benefit, a lot of 401k plans today offer an option that will allow you to put after-tax money into a Roth 401k, and it's payroll deducted. So you can speak to your benefits administrator at work to see if that is part of your 401k plan. So the trick to the conversion, we want to make sure that you have enough money set aside to cover the taxes owed when you have your conversion. What you don't want to do is use the money from the actual conversion to pay for the taxes. So an example would be if you had a $100,000 IRA, you want to convert it this year, you're going to have $100,000 added to your taxable income for the year of the conversion. We don't want to take $10,000 out of the IRA to help pay for those taxes. What you want to do is we want to leave the full $100,000 in there to get that growth. So we don't want to leave a $90,000 left in a Roth because we're going to be not having as much growth, a lesser balance to have growth for your retirement. So the question is to convert or not to convert. I mean, we have the capability to show you which strategy works best for you. Another way around that full conversion, do partial conversions. Break that up. Let's make this a more tax-managed approach. Instead of taking the full $100,000, maybe we break it up over 4 years or 5 years. And that way maybe you'll have the money set aside to pay the extra taxes. But there's some detailed analysis that we can help you do to figure out what strategy is going to be best for you and your IRA. So how Apella works with you. In addition to Apella Academy, we offer a wide variety of planning services to help you get your finances and your financial plans to best suit your needs for today as well as in the future. We offer Social Security analysis, life insurance and long-term care insurance reviews, as well as risk analysis of your investment portfolio to ensure you're properly invested based upon your risk tolerance. You can learn more about Apella Capital and our team at apellacapital.com. So I hope you've enjoyed today's presentation, that you found it useful. Again, this will be up on our website in the next day or two at apellacapital.com. If you do have any questions, there is a text box there. And what we'll do is we'll stay on here for a couple minutes if there are any questions. But if no further questions at this point, I appreciate your time this afternoon. And if you do have anything, please look at our website. You can contact us. My name's Peter Leppones. I appreciate you taking time out of your day today to join us, and have a great rest of your day and a great long weekend. Thank you. I do have a question here from Catherine. Yeah, you actually do have the initials right. It is QLAC, QLAC. That is the reason. That is a reason for doing it, because it will allow your IRA, for the purposes of minimum distributions, you're taking out less money from it during your lifetime. That's sort of benefit number one. Benefit number two is that the QLAC allows you that you cannot outlive your income. So that allows you to maybe be down the road with the IRA. You could start doing different things with it, like gifting strategies, paying for college for the kids, things of that nature. So it's sort of there's two benefits to it. And again, it's not for everyone. Some people might like the fact that they like their minimum distribution being less, and others might like the fact, hey, you know what? I like the fact I'm not going to run out of money. I know, come hell or high water, that I am going to have this money here, whether my IRA is here or not. This QLAC is going to pay me out every month for as long as I live. The question is, once you put your money in to the QLAC product, and these are basically annuity contracts through insurance carriers that are backing the guarantees. No, you can actually, and that's a great question, you can actually flip the switch earlier. So if you initially said 85, you're 65 today, you open it up saying, I'll take the money at 85, but you decide, geez, I really want it at age 80. You can do that. However, the amount of the payment will just be less. But no, great question. Okay, I think that concludes our questions for today. Again, thank you everyone for joining us, and have a great rest of your day. Take care.